Okay, hello everyone. My name is Juan Manuel Alvarez Villamil, and today I am going to talk about a very important concept in finance, the value at risk methodology, or VAR. Okay, in finance, understanding risk is just as important as making a profit. This presentation, we will see exactly what VAR is. We will also look at the economic factors that affect it, the specific risk in fixed income, and the two main ways to calculate it. That is the parametric VAR and the historical VAR. Okay, let's begin. Okay, in this slide, we will see what is value at risk. Okay, let's start with the definition. What is value at risk? The VAR is a number that tells us the maximum potential loss of an investment over a specific time with a certain level of confidence. For example, 99% ones of on one day VAR of $1 million means there is only a one chance of losing more than $1 million in a single day. It gives us a clear and holistic view of market risk. It takes many complex risks and consolidates them into the simple number. Okay. It use math and statistics, not just options. This makes it a very powerful quantitative tool. Okay, next slide. The macro environment and fixed income. Okay, to calculate VAR in fixed income, we need to understand the economy. The central banks control the economy using interest rates. When a central bank wants to control inflation, it uses a hawkish stance. This means a higher interest rate. When interest rates go up, the prices of existing bonds go down. You know. On the other hand, if the central bank wants to help the economy growth, it uses the dovish stance. It means a lower interest rates. When rates go down, the prices of existing bonds go up. This inverse relationship is a basic rule of fixed income. Okay, let's go with the next slide. Okay, before using math, we must identify the specific risk in fixed income. There are 6 main risks. Okay, the first one is the inflation risk. When prices go up, the real value of your money goes down. The second risk is the foreign exchange, the exchange risk. If you buy bonds in another country, the money exchange in the rate can hurt your investment. The third risk is the liquidity risk. This is the risk or not being able to sell your bond quickly for a fair price. The fourth is the interest rate risk. As we just saw, this is when bond prices drop because the market rates go up. The fifth is the reinvestment risk. The risk that you won't find good rates when you reinvest your profits. And finally, we will see the credit risk or default. This happens when the user cannot pay the interest or the principal money. Okay, let's go. Okay, VAR calculation approaches. Okay, now how do we measure this risk? We have too many approaches. The first one is VAR without diversification. This looks at the risk of just a single asset. It is great for analyzing an individual security. The second one is the diversified VAR. In real life, the managed portfolios, this approach looks at all the assets together. It considers the correlations between them because assets more differentially. A diversified portfolio usually has less total risk. This approach is essential for portfolio managers. Okay, parametric VAR methodology. Okay, let's go at the two calculation methods. The first is the parametric VAR. This method assumes that the invest returns allow a normal distributions, like a bell curve. Because of this, we only need the historical mean on the standard deviation. The formula is simple. Okay, VAR equals the zeta curve of our conference level, multiplied by the portfolio balance to the standard deviation and the square root of time. For example, you have a $1 million portfolio. The daily standard deviation is only 1%, like in the image. You want a 99 conference level. The zeta curve is 2.33. You multiply the 2.33 times 1,000,000 times. The returns is $23,000. Okay, but careful, this method assumes normal markets. It can underestimate risk during extreme market crashes, known as SAW events. Okay, historical VAR methodology. The second method is historical VAR. This method does not assume a normal distributions. Instead, it uses real historical data. We look the past returns and store them from the worst to best using percentiles. Let's use the same $1 million portfolio to find the 99 one-day VAR. We take the daily returns of the last 250 días. Short the best. Okay, we look at the worst 1% days, the percent 250 and 2.5. So we look the returns between the second and the third worst days. If that returns was negative 1.5%, we multiply our $1 million by 1.5. Our historical VAR is $15,000. Where this method assumes the future will be exactly like the past, but it requires a very large amount of clean data. Okay, conclusion. In conclusion, a good risk management is more than just math. First, you need macroeconomic data. You must understand inflation and the central bank's decisions. The second, the quantitative precision. You must close the right bar method, parametric or historical, for your specific portfolio. Finally, you need an adaptive strategy. Markets change every day. As financial professionals, we must constantly update our models and strategies to protect our investments. Thank you very much for your attention and have a good day.